Welcome to the deep dive. Okay, today we're tackling something huge. Basically, all of economics. We've waded through a lot of complex material, market failures, global debt, the works.
Yeah, it's a big topic.
And our goal here is really to cut through all that jargon, get to the core ideas, the why behind the economic systems you navigate every day.
And to even start that conversation, you really only need one fundamental idea, one assumption: scarcity.
Right?
It just means there isn't enough of everything to go around, not enough resources, time, focus to satisfy everyone's wants.
Infinite pizza is sadly not a thing.
Exactly.
Hmm.
If it were, economics probably wouldn't exist. So that basic fact, scarcity, forces us all to make choices constantly.
And those choices always come with a cost. That's the next piece, isn't it? Opportunity cost.
Every single time you decide to do one thing
Yep.
or buy one thing, you're giving up the chance to do or buy something else.
Like listening to us right now means you're not watching cat videos, maybe.
Precisely. That's the opportunity cost. And because we all face different scarcities, different costs, different skills, well, that leads us pretty directly to trade.
Okay, so scarcity forces choices, choices have costs, and trade emerges as the solution.
It's a hugely beneficial solution, usually. And it's driven by something called comparative advantage. Now, this is a term people often misunderstand.
Yeah, I think most people hear it and think it just means, being better than someone else at making something.
Right, like winning.
Yeah.
But it's actually more subtle. The sources really highlight this.
So break down that counterintuitive part for us.
Well, the paradox is, trade isn't really about being the absolute best. It's about being the most efficient, or you can even say the least bad, and the right thing. It's about specialization.
Okay.
So even if one country, let's say country A, is technically better at producing both coffee and corn than country B, if country A is relatively much better at coffee compared to corn, it makes sense for it to focus all its effort on coffee and just trade for the corn from country B.
Even if country B is slower at making corn.
Even then, because specialization increases the total amount of stuff produced overall, everyone can end up with more.
Got it. So we specialize, we trade, and all these interactions between buyers and sellers, that's essentially the market, right? The place where this exchange happens.
Exactly. Could be your local farmer's market, could be the New York Stock Exchange. It's the mechanism.
But how does this huge, complex system coordinate itself? Millions of people making millions of choices. Who's in charge?
Well, that's the fascinating part. Often, nobody is explicitly in charge. The coordination happens through signals, specifically through incentives.
Prices being the main signal.
Prices are a huge one. Think about pizza again. If a slice suddenly cost $100...
Yeah, I'm probably not buying it. That's a disincentive.
Right. But if it was $1, well, maybe you'd buy 7 slices. That's an incentive. These price signals guide both producers make more high-priced stuff, and consumers find alternatives for high-priced stuff.
And that dynamic balancing act between what people are willing to pay and what producers are willing to sell, that's supply and demand.
That's the core mechanism.
Yep.
And where those two forces meet, where the number of people wanting to buy at a certain price matches the number wanting to sell at that price.
That's the equilibrium price.
The equilibrium price, yeah. It's that sort of magical balancing point. And this whole process, this self-coordination through individual self-interested choices, that's what Adam Smith famously called the invisible hand.
People talk about the invisible hand like it's some kind of, mystical force.
Yeah, it sounds like magic, but the source material is clear. It's not magic at all.
It's just math.
It's basically math and desire and people trying to get what they need or want, all operating decentrally based on those price signals. It works in silence most of the time.
Okay, but for all this trading and signaling to work smoothly, especially beyond just swapping goods directly, you need something else.
You absolutely do. Bartering a goat for Wi-Fi service is inefficient.
Yeah, probably.
You need money. Money acts as that crucial lubricant for the whole system.
Economic lube. Got it. And it serves a few key functions, right?
3 main ones. It's a medium of exchange, that thing you use to buy the pizza instead of trading a chicken.
Oh.
It's a unit of account, a way to measure and compare the value of different things. How many chickens is that car worth? Money gives you a standard measure.
And maybe the most crucial for stability.
Store value. The idea that the money you hold today will still be able to buy stuff tomorrow or next year, that confidence is essential.
And that brings banks into the picture, managing that value and flow.
Yes, banks are key. They don't just store money. They play a huge role in actually creating it by lending money out, extending credit.
And they charge for that lending. That's interest.
Exactly. Interest is the price of borrowing money, or, the reward you get for letting someone else use yours for a while.
All right, let's shift gears a bit. How does all this stuff actually get made? The supply chain.
Ah, the supply chain. Yeah, that incredibly complex, sometimes unbelievably fragile sequence that turns raw materials into the finished goods you use.
Like the journey of an avocado to become avocado toast.
That's a perfect example. From the farm to the packer, the shipper, the distributor, the grocery store, the cafe. It's like a giant Rube Goldberg machine, but for breakfast.
And that whole machine relies on the basic ingredients of production, the factors of production. What are the classics?
Traditionally, economists talk about land, which is basically all natural resources, the ground, oil, water, lithium, avocados.
Okay.
Then there's labor, which is just human effort, people doing stuff.
Right.
And finally, capital. This isn't just money. It's man-made stuff used to produce other stuff, tractors, factories, computers, espresso machines.
But looking at the sources, those classic definitions feel a little outdated now, maybe.
They really do. I mean, think about the biggest, most valuable companies in the world today. Where does their value actually come from?
Software, brands, data.
Exactly. Intangible assets. Data is arguably a new, massive factor of production. Intellectual property patents, copyrights, brand recognition, these are increasingly where the value lies. And they challenge our old ways of thinking about land, labor, and capital.
So if those are the inputs, what makes some economies so much richer than others? What's the key difference?
At the end of the day, it really boils down to productivity.
More output for less input?
Essentially, yes.
Yeah.
High productivity means you can generate much more value, more goods, more services, more toast per person, per hour worked. You're using your resources, your labor, your capital more efficiently.
Whereas low productivity is waiting ages for one burnt piece of toast.
Kind of, yeah. It means economic stagnation. That's why things like technological advancements, better education for the workforce, and investment in efficient capital are so critical. They boost productivity.
Okay, so we have productivity. How do we measure the overall economic output of an entire country?
That's where GDP comes in, gross domestic product.
The big number everyone talks about. What does it actually capture?
It's meant to capture the total market value of all final goods and services produced within a country's borders over a specific period, usually a year.
And final's key there, right? To avoid double counting.
Exactly. You count the value of the finished bread, not the value of the flour and the value of the bread separately.
And there's that formula everyone learns. C plus I plus G plus XM.
Right, the expenditure approach.
Right.
Consumption, you buying stuff, investment, businesses buying equipment, government spending, schools, roads, military parades, and net exports. Exports minus imports. It's a one way to calculate it.
But focusing just on the calculation can make us miss the bigger picture, you said.
Yeah, I think so. GDP is useful. It gives you a snapshot of market activity, but it's also deeply flawed. One source called it a microwave with no door.
Okay, explain that. What's wrong with it?
Well, it ignores a ton of really important things that contribute to well-being. It doesn't count unpaid work, like caring for children or elderly relatives or volunteering. Huge economic contribution, totally missed by GDP.
Right. What else?
It doesn't account for negative externalities, like pollution created during production. A factory could boost GDP while poisoning a river, It also says nothing about how that income is distributed. GDP could go up, but only because the rich got much richer.
Doesn't measure happiness either.
Not even close. Or sustainability. You could boost GDP this year by chopping down all your forests, but that's obviously not good long-term. Rebuilding after a hurricane boosts GDP too, but nobody feels better off.
So it measures activity, not necessarily welfare. That's a critical distinction.
Absolutely.
Now, economies don't just grow smoothly upwards. They have ups and downs, the business cycle.
Yeah, the cycle of expansion. A boom followed by a contraction, which you call a recession. And sometimes, unfortunately, a really severe prolonged contraction, a depression.
And tangled up with these cycles often is inflation, prices going up.
Right. Inflation is a sustained increase in the general price level across the economy. Basically, your money buys less stuff over time. It usually happens when demand outstrips supply, too much money chasing too few goods.
And there's that particularly nasty scenario where you get the worst of both worlds.
Ah, yes. Stagflation. That's when you have economic stagnation, slow growth, high unemployment, basically a recession combined with high inflation.
Why is that so bad? Or worse than the alternatives?
It's incredibly difficult to deal with because the usual policy tools work against each other. Normally, to fight a recession, you want to stimulate the economy, maybe cut interest rates, encourage spending.
Uh-huh.
But doing that when you already have high inflation, that just pours fuel on the fire, making prices rise even faster. It's a real policy nightmare. More existential dread, as the source put it.
Let's go back to that avocado toast example. Why does it suddenly cost $14?
Well, it could be a supply shock. Maybe a drought hit the avocado farms, or like we saw, a container ship got stuck somewhere, disrupting supply. Less avocado available means higher prices. Or it could be a demand issue. Maybe, everyone suddenly needs avocado toast for their Instagram feed. Or, more systemically, maybe the central bank has pumped too much money into the economy generally, increasing overall demand. Both can lead to inflation.
That leads right into the big question about money management. Why can't governments just print more money to pay their bills or fund programs?
Because, fundamentally, printing money doesn't create more real stuff. More goods, more services, more avocados.
Right.
So if you just inject a ton of new money into the system, but the amount of stuff to buy stays the same, well, you just have more money chasing the same amount of goods.
Which means prices go up, inflation.
Exactly. And in extreme cases, it can lead to hyperinflation. That's when inflation spirals completely out of control, confidence in the currency collapses.
Like Zimbabwe in 2008.
That's the textbook example.
Yeah.
Inflation hit something like 89.7 sextillion%. People were using wheelbarrows to carry cash that was basically worthless. They had $100 trillion bills that couldn't buy lunch. Trust is everything for currency.
Okay, so you need someone managing the money supply carefully. That's the job of the central banks, right? Like the Federal Reserve in the U.S. or the European Central Bank.
Precisely. Their main role is conducting monetary policy to try and keep the economy stable, usually aiming for low, stable inflation and maximum sustainable employment.
And their primary tool for that is?
Setting benchmark interest rates? Think of it as the base price of borrowing money in the economy.
How does changing that rate affect things?
If they raise interest rates, borrowing becomes more expensive for everyone, businesses, individuals buying houses or cars. That tends to cool down spending and investment, which can help fight inflation.
And lowering rates.
Lowering rates makes borrowing cheaper, which encourages spending and investment, hopefully stimulating growth if the economy is sluggish.
Okay, but then there's that other tool we hear about, especially after the 2008 crisis. Quantitative easing, or QE. What actually is that? It sounds complicated.
It is a bit more complex. It's considered an unconventional tool. Basically, when interest rates are already near zero and the central bank still wants to stimulate the economy.
They need another lever to pull.
Right. With QE, the central bank essentially creates new money electronically, not printing physical cash, but adding reserves to the banking system.
Yeah, okay.
And then it uses that newly created money to buy financial assets, usually long-term government bonds or sometimes mortgage-backed securities from commercial banks.
That's the goal there.
Two main things. First, it injects cash directly into the banking system, hoping banks will then lend it out more readily. Second, by buying up those long-term bonds, it pushes their prices up and their yields or interest rates down.
So it's trying to lower longer-term borrowing costs directly.
Exactly. Trying to encourage lending and investment further out, beyond just the short-term rates they normally control. It's like you're printing money, but with extra steps in spreadsheets, as one source quipped.
Got it. So the central bank handles money supply and interest rates. What about the government's direct role in the economy spending and taxing?
That's fiscal policy. This is how governments fund public services, schools, hospitals, roads, military jets, everything else. And they primarily pay for it through taxes.
Mandatory payments, we all know those.
Yep. And taxes come in many forms. You have income taxes, corporate taxes on business profits, sales taxes, or VAT on goods and services, property taxes.
And sometimes controversial ones like a potential wealth tax.
Right, and the structure matters too. Is it a progressive system where higher earners pay a larger percentage of their income? Or a flat tax where everyone pays the same percentage rate? These have big distributional consequences.
And when the government spends more than it takes in through taxes in a given year.
That's a budget deficit. They have to borrow money to cover the difference.
And if they keep doing that year after year.
Those annual deficits add up.
Yeah.
The total amount the government owes from all past borrowing is the national debt.
We hear staggering numbers. The U.S. debt over $34 trillion, Japan's debt over 260% of its GDP. Why should the average person listening worry about a number that big? Does it actually affect them?
It can, absolutely. The biggest issue is servicing the debt.
Meaning?
Meaning a growing chunk of the government's annual budget has to go just towards paying the interest on the money it already owes.
So money that could be spent on healthcare or infrastructure is just going to pay interest on past borrowing.
Exactly. The bigger the debt, the larger that interest payment becomes, potentially crowding out other important spending or requiring higher taxes in the future. It reduces the government's flexibility.
And in the worst case scenario.
The worst case is default. That's when a government simply cannot pay back its debts. Think of Argentina, which has defaulted something like 9 times. It destroys the country's credibility, makes future borrowing incredibly expensive or impossible, and usually triggers a severe economic crisis.
Okay, let's zoom back out to the global picture. We talked about comparative advantage driving trade earlier. That applies between countries too, obviously.
Yes, it's the fundamental reason why countries trade. Brazil might be relatively better at producing coffee. Canada might be relatively better at producing corn or timber.
So they specialize in trade, and free trade, minimizing barriers like tariffs, is generally seen as good for efficiency, right? Lower prices for consumers.
In theory, yes. Global specialization means things get produced where it's most efficient, leading to lower costs and more variety for consumers worldwide. Huge benefits.
But there's a downside.
There's always a cost. The flip side of free trade is structural adjustment.
Which means?
It means that when trade opens up, some domestic industries and the jobs within them just can't compete with cheaper imports. Those industries might shrink or disappear entirely, jobs move offshore. It can be incredibly painful for specific regions or groups of workers.
And that pain often leads to calls for protectionism.
Right. Governments face political pressure to protect those struggling domestic industries, using tools like tariffs, taxes on imports, quotas, limits on import quantities, or subsidies, government payments to domestic producers. It's interference in free trade to shield certain sectors.
And this whole interconnected global system, built on efficient trade, it turns out it's maybe more fragile than we thought.
Shockingly fragile in some ways. The perfect illustration was the Suez Canal blockage in 2021.
Right, the Ever Given ship.
Yeah, one single container ship gets stuck sideways, and suddenly a huge chunk of global trade grinds to a halt. The sources estimated it cost the world economy something like $10 billion per day.
Wow.
It really highlighted how dependent we are on these very specific, potentially vulnerable choke points in our global supply chains. One little disruption can have massive ripple effects.
Okay, let's bring it back down to the individual level again. Labor economics, the market for jobs.
Right, where the product being bought and sold is essentially human time and skills, and the price is the wage or salary.
But this market seems, well, it doesn't always feel like it works according to the neat supply and demand models, does it? Especially when you look at pay disparity.
No, it often doesn't clear efficiently or arguably fairly. One stark point from the source material was the change in CEO compensation compared to the average worker.
What was the number?
In the 1960s, the ratio was maybe around 20 to 1. Today, it's estimated to be over 350 to 1 in many large U.S. companies.
350 times.
Yeah. That kind of divergence suggests something beyond simple supply and demand for skills might be going on, maybe issues with corporate governance, bargaining power, or how value is perceived and rewarded.
And maybe a big part of why these economic models sometimes go wrong is, well, us, humans. We aren't the perfectly rational calculators the basic models assume.
Exactly. That's the whole point of behavioral economics.
Yeah.
It emerged precisely because economists started realizing that actual human behavior systematically deviates from the rational actor model.
We're flawed. What are some key flaws?
Oh, plenty. One big one is hyperbolic discounting. We have a strong bias towards immediate gratification.
Like taking $5 right now instead of waiting a week for $50.
Precisely. Rationally, you should wait for the $50, but the pull of the immediate reward is incredibly strong. It affects savings behavior, health choices, everything.
What else?
Loss aversion. This is huge. Psychologically, the pain of losing something, say $20, feels much more intense than the pleasure of gaining the same amount.
So we're more motivated to avoid losses than to achieve equivalent gains.
Much more. It makes us risk-averse in certain situations and explains things like why people hold on to losing stocks for too long, hoping they'll recover.
And your personal favorite economic flaw?
Has to be the sunk cost fallacy.
Ah, yes. Continuing to invest time, money, or effort into something just because you've already put resources into it, even if it's clearly a bad investment now.
Like sitting through a truly terrible movie just because you paid for the ticket. The money's gone. Your rational choice is to leave and do something better with your time, but the feeling of waste is powerful.
Or finishing a giant meal you don't want because you paid for it?
Exactly. These biases, hyperbolic discounting, loss aversion, sunk costs, and many others, they fundamentally mess with the price signals and rational decision-making that traditional economics relies on.
So, given all these complexities, scarcity, incentives, cycles, human irrationality, how do different societies try to organize themselves economically? We have the big isms.
Right. You have capitalism, which generally emphasizes private ownership of the means of production, free markets, and the pursuit of profit.
Then socialism, which tends to prioritize social or collective ownership or control of resources, with a greater focus on equitable distribution and social welfare.
And historically, communism, theoretically aiming for communal ownership of everything in the absence of social classes and money, though its real-world implementations have looked very different.
But the sources stress that these pure forms are mostly theoretical constructs, right?
Absolutely. In reality, almost every single country in the world operates as some form of mixed economy, meaning they blend elements. Even heavily capitalist countries like the U.S. have significant government intervention. Social Security, Medicare, regulations, subsidies.
And even countries historically associated with socialism or communism, like China, have incorporated huge market mechanisms, private enterprise, billionaires, stock exchanges.
Exactly. It's always a mix, a blend. Every system is essentially a different set of trade-offs, a different attempt to answer those same fundamental economic questions. What should we produce? How should we produce it? And who gets the stuff once it's produced?
Wow. Okay, we have covered a lot of ground, from basic scarcity all the way to behavioral biases and global systems. We've seen scarcity drives choices, choices have costs.
Incentives matter hugely in coordinating those choices through markets.
Money makes it all flow. Productivity is key to wealth, but GDP doesn't measure everything.
Central banks try to manage the cycles. Governments tax and spend. Debt can become a problem.
And the whole system is built on global trade, which is efficient but fragile and run by humans who are, well, not always rational.
I think for me, what really stands out is that every single concept we've touched on, comparative advantage, interest rates, GDP, fiscal policy, even the idea of money itself, is ultimately a human invention.
A tool.
A tool, exactly, created to try and manage that inescapable fundamental problem of scarcity. No system, no tool has solved it perfectly. Every approach involves trade-offs and creates its own set of challenges and risks.
That's a great synthesis. Okay, let's leave our listeners with a final provocative thought to mull over, connecting human behavior back to the very nature of money.
Yeah.
The sources highlighted something pretty fundamental. Most of the money circulating in our economy isn't printed by the government. It's actually created by commercial banks when they make loans.
Okay.
It's called fractional reserve banking money, created largely out of debt.
Right. New loans create new deposits, effectively new money.
So here's the thought. If we know our collective human behavior is riddled with irrational biases like loss aversion and herd mentality that can destabilize markets, and if the very substance of our money, the vast majority of it, is essentially just digital entries and bank accounts created through debt, what does that really imply about the inherent stability and maybe even the true value of the currency you're working so hard to save?